That's your lender right there.
100% of the deals are not going to go to plan.
Don't call me anymore.
That never happens, no.
Never happens? It always happens.
Here's the reason for defaults. And I put it, waste my time fee. And I sent it to him.
Hey, Kevin, I gave you a 5-star review. Can you give me $1 million now?
I went through a tunnel. Your partner's way more expensive than debt.
One of the secrets I'll share with you, please write it down. And then you get yourself a raving fan lender for the rest of your life. The relevance of this fire chat is extremely important for you to understand psychology of money, psychology of working with capital partners / lenders. And I prepared questions for Kevin, who's been a lender for now 20 years?
18 years is Pine Financial, 2 years prior, so 20 years.
Yeah.
Crazy, right?
So Kevin and I met in 2010.
Yeah, I think it was just shortly after that, and you were just getting back into the flipping game.
Yeah. Kevin runs money. He has a fund, or multiple funds now, 5, 6 funds.
Yeah, we have 3 now. We had 6, we consolidated, so we're at 3 active funds.
Kevin's company is called Pine Financial, and Kevin has been a hard money lender, which is actually the opposite. Easy money lender gets e-money. He gives
Whoa.
Easy money lender. Well, hard money lender, that basically is very fair, and they have office. They lend in Colorado, Minnesota, and
yeah. So it's a little interesting, Rafik, because on the residential side, which is mostly where I play, we're in 4 markets: Denver, here, DC, and Wisconsin. It's a very interesting story in each of those. I know it's so random. On the commercial side, we will loan nationally, but we're still pretty picky. So we could talk more about that.
I want to kind of generally talk about the entire sort of setup, and then kind of drill down into psychology. So ultimately, hard money lending for houses and construction. You do a lot of construction loans, right? New construction.
Yeah, mostly fix and flip and new construction.
Townhouses, houses.
Right,
like that.
right.
Yeah. So Kevin and I met, and I was a house flipper, and we did deals. And then after Kevin and I became real good friends, he started lending on commercial. Unless you did it before me, I don't remember.
Yeah, I was doing some commercial, very small.
Yeah.
But then as you got into it and grew, then I wanted to grow with you.
So percentage of your commercial to residential portfolio right now?
We're about 80-20.
80-20. So 20% of, I converted Kevin, like, you got commercial as bigger loans, less, whatever. And then Kevin actually invested in a deal or 2 with me as an LP, right? He provided 100% of the capital. I paid him pref, and we did 2 deals. So ultimately, I want to talk about mindset. I want to talk about deal evaluation and trust. When working with the lenders, they're going to look at 2 things. They look at a deal, but they also look at you as an operator. So what matters more to you, the deal itself or the operator behind it, and why?
Okay, so we're going to talk more on the commercial side because of the room. On the commercial side, I'm much more interested in the sponsor and their ability to perform than I am on the asset itself. The asset is important, though, obviously, and having someone like you or the network here gives me comfort because I have an exit if I have to get out of it. So really, from a lender's lens, how do I get my money back? That's what you're trying to sell me.
You need to have a very, very good business plan working with Kevin. What are the biggest red flags that make you lose interest in a deal quickly?
It's credibility over credit. Does anyone know what I'm talking about when I say that? Yeah. So if I have an interview with you and I'm having a conversation and I don't believe you, then that's going to be a quick deal killer.
Yeah.
So we're going to look at the credit and we're going to look at your ability to repay and those things. But how confident are you in your plan, and can you sell me that plan? That's the easiest way.
Just so you guys know, the 20% that Kevin lent, I would easily say that 5 to maybe 8% of it, like almost 50% of it is within the community we have.
Oh, it's probably higher than that.
Yeah. Oh, cool. So guess what? That's your lender right there. You need money for your deals quick. Within 2-3 weeks, you got to put some money down. But me and Victor actually borrowed money from Kevin, and we bought the building for $800,000, and we sold one part for $600,000. So we're going to be into it for $200,000, and we can refinance. What mistakes do you generally see in how people present deals to you, and what do you recommend for our community members?
Okay, so I'm going to maybe come back to that, but let me just address a mistake. And I heard it when Brian was up here. So Brian, I'm sorry to disagree with you wherever you are. He left. Okay, darn it. So one of the comments that Brian made was he wants a lender to be easy to work with for him. He wants the lender to do the heavy lifting. I would highly encourage you to not do that. As a lender, we want you, when we ask for something, to get it to us. If I'm waiting 2, 3, 4 days, a week to get something from you, that file's going to the side, guys, and we're hitting up against a deadline. It may not close. Don't ask me to do your work for you. I don't know Brian, but you could let him know I said that.
So what are your non-negotiables when it comes to protecting your capital?
Okay, so the deal has to be, I know I said the sponsor is more important, so I'm going to come back to that, but the deal has to be strong. It has to be profitable. So we're going to run it through a profitability test, just like you were talking about when you did your live deal, which was really cool, by the way. But what is a profit going to look like? And is that sufficient when the shit doesn't go the way you're expecting it to? Because look, guys, it doesn't. I could tell you about maybe, 100% of the deals are not going to go to plan. So what happens when it doesn't go to plan? So there has to be enough room in the deal and your plan to get out anyway. And 2, liquidity. Income doesn't really matter to me or most private lenders because your income's not going to make the payments on the loan, right? The property does. So I don't care so much about that. Credit to some extent, but I do want to see liquidity or access to capital. When you go over your budget, when you take too long, when all the other things go wrong, do you have the ability to get out of that situation? Last thing I want is your problem, my problem. So can you handle your own problem?
I'm handling it. 2 years later.
Rafik, we have some problems.
We don't have a problem. Just pay you off. When Kevin started, he was lending money at 100%, which was absolutely like crazy to me. Like he was lending 100% of the acquisition, the rehab, subject to 70% IRV. Like a friend of mine yesterday is like, man, we do 30% margin. But a lender like Kevin could finance 100% of it, but it's going to cost you 15%. So if you have your systems down, that was great. What are the main things that you look for in underwriting commercial real estate deal? I mean, we talked about the operator. And what are the things that are very important to you?
Well, it goes back to like a lot of what you were saying. You like taught an amazing class just there because what we're looking for is the quality of the asset. So one of the things, for example, is the population. How dense is the area? So we want 75,000 people in a 5-mile radius. Like under that, and it's probably not going to work for us. If it's retail, we want to see the traffic counts. Now, it's not quite 18,000, but I know that's the nationals what they're looking for, but we do want to see some traffic. So it's the same things that you would be looking at as a sponsor, we're going to be looking at as well.
Mm-hmm. Have you taken any commercial properties back?
Yeah, I think the one I did, you knew about. Thank you for helping me with that one.
Why did that deal not work out?
Here's the reason for defaults. So if you're lending money to peers or each other, these are the reasons to look out for. Lack of liquidity is probably the number one. Getting in over your head. So if you're doing too many deals, look, I want you to make money. Trust me, I want you to make money. I don't want you to make too much money, especially on your first deal or two, because what happens is your head gets big, you're no longer humble, and now you could do 4 deals, 5, 6, and there's no foundation. And then that's when it all crumbles. So we have some limitations around borrower exposure and the borrower's exposure to deals. So what did I say? And then the last one is divorce, which you can't underwrite for, unfortunately, but not marital divorce, business divorce. That's where we're seeing some defaults.
Yeah.
So when you get in bed with your partner, make sure that you guys actually have a good relationship. Everyone's adding value, like you were talking about, Alexandra, in your presentation. That's very important.
And so when I drill, invest in relationships, every deal is down payment on the next one. I hope you guys will understand and live like that, because deals come and go, but relationships is where you can actually build an empire, because a great relationship is like a gift that keeps on giving. Like I would love to do another deal with Alexandra or Brian or Gustav. Just find deals. And if I find a deal like Alexandra, do you want to run that deal? Sure. Ooh, we almost did one and it didn't work out. For whatever reason.
So you're talking about relationships here, which is vital to this business. This is a people business, not a commodity business. I really believe that. You and I had a rough start, eh?
Yeah. You tell them that story.
I know. I was going to ask you tell them that story.
There's partners and there's lenders and there's a hybrid. if you have some issues with the credit and stuff, Kevin will fund your deals. And when we met, his pricing was slightly higher than what I used to paying. But, and so I think we talked about a couple of deals and I went with Renovo or something like that. And so I wanted to do another deal. And Kevin was like, look, I spent money on 2 of your deals or 3, I don't remember. And unless you pay me for my time, don't call me anymore. Don't call me anymore. And so he gave me an invoice for $1,500.
I sent him an invoice. I didn't even invoice it, so I had to go into QuickBooks and like figure out how to create an invoice. And I put a waste my time fee, and I sent it to him.
I think when he sent the email, he thought it's the last email he'll send me, and then he gets a check for $1,500.
Yeah, I thought the relationship was done at that point, but
so I bought him back.
What did you think when you got it?
I felt bad because we worked on a couple of deals, and sometimes these deals don't work out. But and the other thing is, I'm kind of sometimes shy to ask from a new relationship, and I have a lot of other relationships. Now, Kevin is a lender, by the way, and of course, every time there's people with money, what do? We pitch them equity deals, right? And I don't know, anybody else pitches any of your customers do it?
I get that all the time.
Yeah.
Here's the thing about equity versus debt. I don't know if this is in your question, so I'm jumping ahead. Let me know. But like sometimes you'll say, I want to pay the lender these fees or this interest rate or whatever it is. But your lender is a partner in the deal, right? Maybe they're a safer position being an lien holder instead of an owner. But they are a partner in the deal. And I'll tell you what, if you're doing quality deals like Rafik's teaching you, your partner's way more expensive than debt. An equity partner is going to be 50% of that deal is, do the math.
And you have to understand, it's all about risk reward, right? And equity should generally generate more than the debt, usually. And so when we pay our equity 15, 20, sometimes 36%. On the deal that Kevin did, the first deal we did was a Goodyear deal.
Yep.
And we actually made $1 million. I was very happy to have obliged. And then we 1031 it into another deal. And that deal we did really well on too. We bought it for 4.7. It's worth 7. It's cash flowing. We actually distributed cash flow.
Yeah, we got all of our money back.
Yeah. And then I invested. I get $3,000 a month. We get $3,000 a month. So if you invest $300,000 with him, which we did $300,000 in your fund.
Yeah.
Our company did.
Yeah, so we got all of our money back. We invested like $300,000 into the fund, so now that's producing income, and we rolled over the rest of the profits into the new.
And it's cash flowing, yeah. So it's like if you invest in relationships, my credit mentally is I think maxed out with Kevin right now. I got to pay him off, but at any point in time, I think I got a $5 million line of credit. It's in my mind because that's what I almost owe you right now. So, but if you need more money to be lent, let me know. I'll get you more. All right. So, any other questions? By the way, do you have any questions for Kevin? Any of you? Because money is very, very important to our deal. It's like it's a basic lifeblood of our business. And most of us, when we get into this business, we are so nervous about not having capital to back us up that you don't even go for it. So if you have guys that have 250, and he's got a responsibility to his investors to deliver them, 10% return. So he's constantly trying to lend that money out. So do you have any questions for Kevin?
Is the market important for you?
So the demographics on the deal are important to me. The market specifically, not necessarily, but what I want to see is that you or whoever's borrowing the money has some experience in that market, or you're partnering with somebody that has some experience in that market that is actually signing on the debt. So we require personal guarantees, which I know a lot of you hate. I understand that. We're going to take it. We need the personal guarantees. So we typically will want whoever's guaranteeing the loan to be familiar with the market.
How many deals is experience for you?
I mean, you get exit one deal and you're good.
Oh, nice.
What's your lending limit per deal, maximum loan amount?
Yeah, so our maximum loan, we just increased it a little bit, $5 million, so we're still pretty small. I mean, look, we have $260 million, so we got to keep it spread out.
So on a deal like I showed earlier, let's say one of our new members want to partner do a deal. How on a $7 million purchase with a $9 million stabilization value, what kind of LTV would you lend? I think it cash flows day one.
Yeah, we've gotten a little bit stricter with some of the noise in the market. So we're at 60% of stabilized value. Everything we do is on what's the end product, right? What are we trying to accomplish? So we're at 60%. So there's a chance that you could do no money down deals still, like you said. There is that chance. We're seeing some down payments right now.
Who wants to do a no down payment commercial deal? Please raise your hands. Now, can you multiply $8.8 million by 60% and tell me what that number is?
5.280.
5.28. So you got to put $1.7 million to do that deal. Capital is available. And there's companies like Kevin's that actually look for customers. So I said, Kevin, you can join the community and I can pay you, or you can pay. Anyway, we'll benefit because he needs to dispense capital, and we're going to try to bring more investors. And if we cannot deploy the money, I'll just park it with Kevin and he'll lend it to us. The average investor of Kevin's wants to get 10%, and Kevin lends at about 15%. Then 5% is basically his margin on the capital. I want you guys to think about it that way. It's like he's a store and he sells money, but he has cost of his funds too. And to the extent that you understand the formulas, to the extent that you understand how to structure deals, having a lender who is not requires substantial down payment is really, really good partner to have. And so if you find a deal that qualifies at 60%, Kevin, up to $5 million will give you 100% financing on that deal. You follow? So the whole bunch of, the money is not a problem anymore now that you have Kevin in your life. You go ahead and Bill.
Are you doing interests and points, and what type of term, and upon the length of the term, then do you have additional reapplication points to continue? What's your structure?
Yeah, we have some flexibility here, but I'll tell you what the typical structure is. And I also should share this. We talked about the 80-20 mix, and there is so much demand for commercial bridge debt right now that we can't meet. I mean, I'm going over the 20% constantly, so I'm constantly pulling back. So is money still potentially a problem after meeting me? Yeah, I'm sorry. We might say no to commercial deals. So I wanted to make sure I get that out there. I came here not necessarily looking for business, Rafik. I came as your pal and trying to help as much best I can. So I wanted to say that. Now, to answer your question, we're at 2 and 12, so 2 points. 12% interest, and we're typically on the commercial stuff go about 18 months. Now, again, I have some flexibility there. If you need longer than that, then we are going to have to re-up for some fees because, look, I make the bulk of our money comes from the fees, not the interest. We're charging 12, not 15, so my spread's closer to 2 minus cash drag.
One of the secrets I'll share with you, please write it down. It's on the camera right now. Can I tell him a secret? So here's what happens. Kevin gives you a loan.
Do I have a choice?
You get it going, and then you say, "Hey, I did so well here, Kevin. Thank you so much. I appreciate you." And you give him an exit fee. Most of the time, it's expected. Hey, if we do well, whatever. But exit fee. In other words, you got 12 and 2, and then you give him a little bonus after you close down the loan, and then you get yourself a raving fan lender for the rest of your life. You know what I mean? Does that make sense?
Yeah, but you know this, man. I'm not going to take an exit fee from you or anybody else. I just don't play that way. We're very transparent, and I don't take equity. I don't take exit fees unless we're getting to the point where we're extending too much and I have to choose between hitting you hard or taking it back. Yeah. Then we'll start talking about that.
So you follow? And of course, Kevin is a big company. He's almost an institutional lender now at $250,000. But if you deal with smaller lenders, like we've got $10, $20 million, and you do that, it works like magic. And so this is where the whole concept of over-delivering goes, right? Because you have to understand, everybody else, what are they doing? They're chiseling him down. Julie was complaining about this client. It's like, oh, I paid you so much, and I want to get a discount because I'm paying you off. She's like, what the hell? I work so much, I got to get paid. But of course, Julie doesn't want to do business with that person again. So it's all about positioning yourself. Do you have any questions?
Julie, I hear this all the time from people. I've paid you so much in interest. Look, guys, I didn't go into my pocket.
Exactly.
I have investors I have to pay. So you agreed to pay the interest, right?
Mm-hmm. Some people have great. Yeah. Yes, go ahead, Hashim.
I didn't get the part about your ratio of lending, the 40-60 traditional lending is
80-20.
75% to loan value. Sounds like you were lending on the pro forma.
On collateral value.
Yeah, we're going to lend it on the stabilized value. So what is that property worth when it's fully, the pro forma, what is it fully operating? We are going to take a vacancy factor, which was
5%.
conveniently left out of the board up here. But take that,
There's
add
levels
that
of
in,
complexity to it, yeah. 5% vacancy.
and we're going to do 60% of that. But we get full appraisal. And there's a ton of information in those.
When you do
reports.
value add deals, 60% of stabilized value is usually would be about 90 to 93% loan to value if you find the right deal.
And these are non-income producing properties, guys. This is stuff that banks typically won't do.
Yeah.
But an appraisal value is not going to reflect your future performance. It's only going to be your current value. So how does that work?
No, it's a stabilized
Value. That's the secret sauce here. Forget about the current cost basis. Talking about value. Now, I know you said you lend in Colorado, Wisconsin, Minnesota, and DC. For a commercial deal, would you go out of those territories and lend in Chicago, for example, or Seattle?
Yes.
Yeah,
with the right sponsor. That's why I said my first answer was a sponsor is pretty important. I want to know that you could actually perform.
Yeah. So when sometimes you buy a property that's a no-brainer, right? It's such a smoking deal. You don't want to bring a partner on it. You want to, do it yourself. Kevin is your partner. To the extent that it qualifies, he will finance 100% of the transaction. That's where like the whole I don't have any money goes out the window because Kevin has the program that actually works, and he will give you up to 100% of the cost basis purchase price. But by the way, the other thing that Kevin does, he finances rehab in escrow.
Yeah, that's a good point. That 60%, that has to include the money that you're budgeting for the whatever it is that you're doing to stabilize. I'm not just giving you 60%. It's 60% advance minus our holdback, which might be the facade and the white box or whatever it is that you're going to use to execute the plan. We have to have that money set aside for that.
Yep.
Imagine you do draws, verified draws.
Exactly.
Draws and pictures and stuff. Yeah.
Draws and inspections, the whole thing. Yep.
How quickly can you close for commercial?
How quick can I get that appraisal?
So a couple days.
Oh, the question, how fast can I close?
If you have an appraisal already, maybe in hints.
Yeah, so he calls me in a panic and he has a full file because his bank bailed on him again.
Yeah.
Exactly.
I can close that week.
Oh, Claire, he actually closed on our Claire deal. Yeah, thank you very much. Yeah, because they don't want to sell it anymore. Kevin, can you wire us money? Alexandra's crying. Okay, fine. Go ahead.
Do you do any second positions?
No, I don't. I want the recourse because the sponsor's balance sheet is very important to protecting my investor capital.
You ever cross collateralize?
All the time. So the question is, do I cross collateralize? Yes, we do that. We can get pretty creative.
Can you talk about the cash out and DSCR?
I don't do a lot of DSCR, but a debt service coverage ratio, that's really just a term for a loan that is based on the cash flow from the property. So typically what we're seeing in that space now is absurd, but we're seeing qualifying at 1 times or sometimes even less. So I've seen some approvals at 0.7 DSCR getting approved. And this is more on the single family side, but it's quite bizarre.
So creativity in the way you structure deals is so important. So you've got to always ask questions. Maybe the answer is no, but you will ask. Kevin, I know your IRR is about 14 to 15%. That's what you want for your investors in your company. And I know you have to pay people 8% pref. Would you consider an 8% loan with 3% on the front and 4% on the back? 8% carry, interest only, 3% on the front, because then if you front load and then 4% on the back, that's 15. Is that something you've done before?
I have not done that before because I try to keep the business very simple. When you start getting crazy and like this,
Consistencies?
then it's hard to scale. And for me, it's like if I could just produce widgets, and just go, that's what's most important.
Okay.
So the answer is maybe.
Yeah, then take it out for an answer.
Damn it.
Like Grant Cardone says, my wife said no, and then we have 2 babies.
But why would you want to do that? I mean, my question would be why? Are you
Cash flow.
expecting to ask me for an extension at some point and trying to push that exit fee down away from me? Or what's
Why would anybody push anything down, dude? It's like, it's stupid.
that never happens, no.
Never happens? It always happens. There's a lot of capital sources that, provided you have a deal, they'll give you money. And a really good deal will be at 60% of ARV, right? Yeah. And not in Texas maybe, but in Minnesota for sure. Yeah.
What if someone is not
super liquid but has a bunch of equity? Would you take like
I had a mentor tell me once, it's really hard to buy a beer with equity.
Yeah, that's a good one.
Does that answer the question?
Now here's what I would do. Like, this is a creative, and tell me if you allow that. So I have a lot of equity here, and you like maybe it's 30% LTV, and you buy in a property, and you say, look, I need $1 million to buy this building. I don't have any cash. How about we'll give 1.2 million, secure $200,000 in the junior lien behind the very low LTV deal, and then keep $200,000 as interest reserve.
So I will do that. That's a good point. I'll cross-collateralize other properties to secure a payment reserve or something to help relieve some cash strain, but I'm not going to approve a loan if you don't have cash because you need cash to get through your project.
Yeah.
So I could relieve some pressure with some kind of payment, like payment relief, but I'm not going to allow you to put yourself in a bad situation.
Let's give Kevin
a couple things. I know that a lot of people lend to each other. And the reason I know that is because I get a call, 1 or 2 every single month. And here's how the call goes, Rafik. Kevin, can you save me?
I love money. I can give you money back.
I don't know what I did. I loaned in junior position and now I don't have enough to buy out the first. I'm going to lose all of my money. The first is for whatever the situation is, whatever the mistake is. I get these phone calls. How do I get out of the situation that I shouldn't be in the first place? So I did write a book, and you know this. It just came out yesterday. So I asked my team.
Go to Amazon, buy the book.
I asked my team, how do we get the lowest price for Rafik's group for this book? And you know what? Amazon is allowing it for free.
Oh, nice.
Did you know they did that?
All right, you guys whip out your Amazon right now. Find his book. What's it called?
It's called Private Lender's Vault.
Private Lender's Vault.
Private Lender's Vault.
And then you get it for free.
And you can get it
courtesy
for free.
of Kevin Amolsch.
So Private Lender's Vault, you can just do privatelendersvault.com and it'll take you to the Amazon page. That's only going to be like this weekend, I think, and then we're going to actually start trying to sell it and make a little money from it.
So guess what?
The Kindle.
Yeah, the Kindle's free.
Thank you. Free book. Guess what, guys? You read the book, you find some key phrases, and when you call Kevin, hey, Kevin, I really liked how you talked about XYZ on page 34. Paragraph number 2. Man, genius. By the way, can I lend you some money?
I'm going through a tunnel.
Hey, Kevin, I gave you a 5-star review. Can you give me $1 million now?
Going through a tunnel.
For your office, are you the main one that handles the commercial properties or someone else?
No, so my team is growing. We have 19 people in the office now. We do about 200 or so deals a year.
Does Sean do the commercial?
Sean will do commercial in Minneapolis, yes.
All right, guys. Anybody needs money for your deals? Kevin is your guy. If you can't find money for your deals, talk to me, and then I'll take 50%.
I do want to say one last thing. Guli and Rafik, no one has said thank you for putting this on today. So I just want to say thank you look at this amazing group. This was intimidating to get up here, you guys, because there is so much talent and capability in this room. This is quite amazing what you're accomplishing, and I know this is a lot of work, so thank you.
Thank you very much. Appreciate it. Yeah.